Price of silver you see every day isn't real. What if the global silver market, the same one investors trust, governments reference, and industries depend on, isn't driven by supply and demand at all? Cut to flashing price charts. Silver is supposed to be money, a hedge against inflation, a store of value for thousands of years. Yet for decades, it has behaved like something else entirely, muted, suppressed, and strangely disconnected from reality. And at the center of this mystery is a quiet financial invention most people barely understand. ETFs raise the central mystery. Exchange-traded funds were sold to the public as tools of transparency. Simple, ways to gain exposure to assets like silver. But what if ETFs didn't liberate the silver market, but captured it? What if the very vehicles meant to give investors access have become the mechanism that controls price, absorbs demand, and masks shortages? To understand how silver became one of the most manipulated assets in modern history, we need to rewind, not years, but centuries. Silver before ETFs. For over 5,000 years, silver was money. Not a commodity, not a derivative, money. Empires rose and fell on silver flows. Wars were funded with silver trade between East and West depended on silver settlement. From ancient Greece to Rome to China's silver-based tax system, silver was trusted precisely because no central authority could create it out of thin air. And that was the problem. The gold standard ends, silver becomes dangerous. In the 20th century, governments slowly abandoned gold and silver-backed money. Fiat currency replaced hard assets. Trust replaced discipline. But silver didn't disappear. It remained essential for industry. It remained trusted by the public, and most dangerously, it remained finite. A silver represented something modern finance could not tolerate, an external check on monetary power. So the question wasn't if silver would be controlled, it was how. The birth of paper silver. The first step was simple: separate silver ownership from physical silver. Futures contracts allowed traders to buy and sell claims on silver rather than metal itself. Over time, 1 ounce of physical silver backed dozens, then hundreds of paper claims. Price discovery moved away from vaults and into trading screens. Silver didn't become more abundant, it became more synthetic. But futures alone weren't enough. They were volatile, visible, hard to explain to the public. What came next was far more elegant. In the early 2000s, a new financial product arrived with perfect timing: the silver ETF. The pitch was irresistible: easy access, low fees, no storage hassle, backed by physical silver. The largest of them all, SLV, launched with explosive success. Billions of dollars poured in. For the first time in history, demand for silver could be redirected away from physical metal and into paper representations. What ETFs changed the critical shift. Here's what most investors never realized. When someone buys a physical silver bar, metal is removed from the market. Supply tightens, price pressure increases. But when someone buys a silver ETF, no physical delivery occurs. Authorized participants can create or redeem shares. Demand is absorbed, diluted, and neutralized. ETFs didn't increase silver demand. They redirected it into a controlled channel. The authorized participants. Behind every silver ETF is a small group of institutions called authorized participants. These are not retail investors. They are global investment banks, bullion banks, market makers. They alone decide when shares are created, when metal is added, or not, when price pressure is released. And here's the uncomfortable truth. These same institutions also dominate the futures market. The illusion of abundance. ETFs created the appearance of endless silver supply. Charts showed growing ETF holdings, stable prices, healthy markets. But behind the scenes, physical inventories barely grew. Leasing and rehypothecation exploded. The same silver was counted multiple times. The market looked liquid because it wasn't physical. Foreshadowing the breaking point, this system works only as long as one thing remains true: that investors don't ask for the metal. Because the moment physical delivery is demanded at scale, the illusion collapses. The trap is set. Silver ETFs didn't manipulate the market by force. They did it by design, by absorbing demand, by delaying price discovery, by replacing ownership with exposure. And now the question isn't whether silver has been manipulated, it's how long the system can survive once people see it. The core question returns. If silver is so essential, if mine supply is constrained, if industrial demand keeps rising, then why doesn't the price reflect it? This question has haunted the silver market for decades, because in every other commodity market, shortages show up quickly. Oil spikes, natural gas explodes, lithium triples. But silver? It hesitates, it stalls, it drifts sideways. That hesitation isn't accidental. How price discovery was hijacked? In a free market, prices are discovered where buyers and sellers exchange the actual good. But silver no longer trades that way. Today, the global silver price is discovered primarily in futures exchanges, ETF, share creation, and redemption. Derivative contracts, not in physical vaults. The market that sets the price of silver rarely touches silver at all. The futures market, where silver is sold without existing. Let's start with futures. A futures contract allows someone to sell silver they do not own for delivery at a future date. In theory, this provides liquidity and hedging. In practice, the volume of silver traded daily is 250 times global mine production. Most contracts are never settled in metal. Cash settlement replaces delivery. Silver is sold again and again and again without ever leaving a vault. The role of short positions. Now comes the critical mechanism. Bullion banks and large institutions maintain massive short positions in silver futures. Short selling creates downward pressure. But here's the difference between silver and other assets. Shorts are rarely forced to cover with physical delivery. ETFs absorb demand that would otherwise expose shortages. Price suppression becomes self-sustaining. In silver, shorts don't fear scarcity because scarcity is masked. ETFs as pressure valves. When investor demand surges, something strange happens. Instead of price rising sharply, ETF shares are created, demand is met with paper exposure, physical drawdown is delayed or avoided. ETFs act as shock absorbers. They convert panic buying into manageable accounting entries. The result? No visible shortage. No violent price discovery, no forced reckoning. The authorized participant advantage. Only authorized participants can exchange ETF shares for metal. Retail investors? They can't. Even large investors? Often can't. Unauthorized participants just happen to be the same institutions dominating futures trading. They see order flow inflows and outflows, market stress before anyone else. They don't react to the market, they shape it. Why silver is different from gold? Gold has similar structures, but silver behaves very differently. Why? Silver is consumed, used in electronics, solar, medicine. Much of it is unrecoverable. Silver inventories are thin, most above ground. Silver is already spoken for. Little buffer exists. Silver price is politically sensitive. It exposes currency debasement faster than gold. Silver can't be allowed to signal distress. The inventory illusion? ETFs report large silver holdings. But what those reports don't show, leasing arrangements, swap agreements, rehypothecation. The same silver bar can, back an ETF, serve as collateral, be promised elsewhere. One bar, multiple claims. This works until someone asks for delivery. And when delivery is requested, every manipulation scheme has one weakness, physical withdrawal. And when investors attempt it at scale, delivery times lengthen, premiums rise, cash settlements increase. The system doesn't break loudly, it leaks quietly. Early warning signs? These signs already exist. Rising premiums on coins and bars, disconnect between spot price and retail price. Inventory declines at key exchanges. Sudden rule changes during volatility. These are not coincidences. They are stress fractures, foreshadowing the breaking point. ETFs can suppress price only as long as confidence holds. But confidence is fragile, and when enough investors realize they don't own silver, they own exposure. The question won't be, what is silver worth? It will be, who actually has it? Pressure without release. Silver isn't undervalued because it's unwanted. It's undervalued because demand has been redirected, diluted, and controlled. ETFs didn't destroy silver. They postponed its reckoning. A pattern history keeps repeating. Every paper market built on a physical asset eventually faces the same test. Not speculation, not sentiment, not price, delivery. History is brutally consistent on this point. Whenever claims on a scarce asset exceed the asset itself, one of two things happens. Physical delivery is suspended, or the price explodes. Silver has already walked this road before. What, the Hunt brothers? What really happened? The story most people think they know begins in the late 1970s. Nelson and William Hunt didn't trust fiat money. They didn't trust governments. And they didn't trust paper silver. So they did something radical. They bought physical silver, a lot of it. At their peak, the Hunts controlled roughly 100 million ounces of silver futures contracts demanding delivery. A meaningful share of global supply. Silver prices exploded from under $6 to nearly $50 an ounce. And that's when the rules changed. Rule changes, the first emergency brake. Exchanges introduced liquidation-only trading. No new long positions. Margin requirements raised overnight forced selling. The message was clear. You can speculate, but you cannot drain the system. The hunts didn't fail because silver wasn't scarce. They failed because the system refused to deliver. Why that event matters today. The Hunt Brothers episode is often used as proof that silver can't rise. But the real lesson is the opposite. It proves that physical demand breaks paper systems. The only reason silver didn't reset permanently in 1980, because ETFs didn't exist yet. Why ETFs changed everything. In 1980, demand hit the physical market directly. Today, demand is intercepted. ETFs absorb investor interest. Futures markets absorb speculation. Physical markets remain starved. This allows suppression without confrontation. No emergency rule changes, no headlines, no visible panic, just quiet control. The illusion of liquidity. ETF liquidity creates the appearance of abundance. Billions can flow in and out with minimal price movement, but this liquidity is financial, not physical. It vanishes the moment delivery is required. And history shows what happens next. Modern stress events you probably missed. Over the past decade, silver has quietly tested the system multiple times. Sudden inventory drops at major exchanges, delays in large physical orders, rising premiums despite flat spot prices, ETF inflows that did not result in metal accumulation. Each time, the response was the same. Cash settlement, rule reinterpretation, silence. These weren't failures, they were rehearsals. Why a silver breakout would be violent. When silver finally breaks free, it won't rise gradually. Why? Because the price has been artificially compressed, physical inventories are thin, industrial demand is inelastic, shorts are structurally trapped. When confidence snaps, the repricing is not incremental, it's discontinuous. The industrial wildcard. Unlike gold, silver cannot simply be hoarded. It is consumed, every solar panel, every EV, every medical device. Once used, much of it is gone forever. This means the longer price is suppressed, the more violent the eventual shortage. ETF inflows, the final mask. When panic buying begins, ETFs will see record inflows, but instead of exposing shortages, they will create new shares, delay metal withdrawal, absorb demand again until they can't. And that moment will not be announced in advance. The trigger nobody sees coming. Breakdowns don't begin with headlines. They begin with one failed delivery, one rejected redemption, one delayed shipment, then whispers, then premiums, then silence. And by the time the price moves, the metal is already gone, foreshadowing the endgame. The silver market doesn't need everyone to wake up. It needs only enough investors demanding metal, enough industries refusing cash settlement, enough distrust. And when that threshold is crossed, ETFs stop being stabilizers. They become accelerants. The trap tightens. Paper silver survives on confidence. Physical silver survives on reality. History shows which one always wins. The breaking point. When confidence dies. Every system built on confidence eventually faces a moment when belief collapses. For silver ETFs, that moment does not arrive with a crash. It arrives with a question, a single request. I'd like delivery. What breaks first isn't the price. When the silver system breaks, price is not the first casualty. What breaks first is settlement timelines, redemption guarantees, transparency. Delivery windows quietly extend, cash settlement becomes standard practice, authorized participants stop redeeming shares, and the public isn't told why. ETF redemption, where the illusion ends. Silver ETFs promise exposure, not ownership. But during stress events, that distinction becomes fatal. And when too many shares chase too little metal, redemptions are discouraged. Physical withdrawal becomes impractical, price disconnects from reality. ETFs don't default loudly, they redefine success. The moment the market splits. This is when silver becomes two markets. Paper silver futures. ETFs, cash-settled contracts, physical silver coins, bars, industrial supply, and they no longer agree on price. The true price migrates away from screens and into scarcity. Who loses? When the system breaks. Every manipulation has victims. In silver's endgame, they are clear. Retail ETF holders, exposure without control, no delivery, no leverage, late-stage speculators, buying price action, not metal, industries without secured supply, forced to pay any price or shut down. By the time the price catches up, access is already gone. Who wins? Quietly. The winners never announced themselves. They already acted. long-term physical holders, industries with secured off-market contracts, nations with strategic stockpiles. They don't celebrate the spike. They survive it. Failed fixes. Why the system can't be saved. When silver finally escapes control, authorities respond the only way they know how. But every fix fails. Fix number 1, release reserves. Most silver is already leased or pledged. Releasing it reveals the shortage. Fix number 2, change rules. Cash settlement becomes mandatory. This confirms the problem. Fix number 3, suppressed price premiums rise anyway. Markets fragment. Once confidence is lost, no regulation can restore it. Modern parallels. You're seeing, right now, this story isn't unique to silver. You've seen it before. Banks freezing withdrawals, commodity exports suddenly restricted energy shortages despite ample supply, crypto exchanges halting redemptions. Every time, the pattern is identical. Paper promises fail first. The deeper truth about ETFs. The ETFs weren't created to destroy silver. They were created to manage it, to absorb demand, delay shortages, protect currencies, maintain confidence. And for decades, they worked, until they didn't. 3 clear takeaways. 1. Price is not truth. Price reflects confidence, not reality. Reality emerges only at delivery. 2. Exposure is not ownership. ETFs offer convenience. Physical ownership offers control. Only one survives stress. 3. Suppression creates violent repricing. The longer silver is restrained, the more explosive its eventual release. The warning. The greatest risk in silver is not volatility, it's complacency. Believing that liquidity is infinite, settlement is guaranteed. Paper claims equal metal. History punishes that belief, every time. The open question. When the silver market finally reveals its true structure, when the ETFs stop absorbing pressure, when delivery matters again, who will already be positioned and who will still be watching charts? If this changed how you see silver, markets, or ETFs, stay curious. Question structure, not headlines. Understand mechanisms, not narratives. And if you want more deep dive breakdowns into markets, manipulation, and hidden systems shaping the future, subscribe, join the conversation, and keep asking the questions most people avoid. Because the most dangerous markets aren't the ones that move fast, they're the ones that stay calm right before they don't.